Thanks for tuning in to this week's Signature FD investment audiocast that we call Cutting Through the Noise. I'm Tony Welch, Chief Investment Officer at Signature FD. So, we're going to start this week with our chart of the week that's titled Crisis Events. Our friends at Ned Davis Research keep a running catalog of various impactful geopolitical events through time. Things like the JFK assassination, military conflicts, financial crisis events, and so on. The US strike on Iranian nuclear infrastructure may also qualify as one of these events. We got some client questions in which folks were surprised that oil has fallen and stocks have rose since the strikes. And we were reminded that the initial market reaction to a crisis event is about a 3% drop, but then a recovery of 17% over the subsequent year. And we can see here that the S&P 500 has now in fact traded to an all-time high, returning about 5.7% year to date thus far. International stocks have also rallied strongly, aided by weakness in the US dollar. Now, we're cognizant that there's some building inflation pressures here. This chart shows the NDR inflation timing model in orange. It's comprised of 22 leading inflation indicators, and we can see that it's reached its highest level since the 2022 inflation surge. Now, this doesn't mean that inflation's going back to 9%, but there is at least some underlying inflation pressure that's out there. Now, one potential offset to rising inflation pressures has been falling oil prices. Oil prices are down over the last year, and as this chart shows, the economy tends to perform well when oil prices advance 8% or less in a 12-month period. So, if companies do begin to pass through tariffs, there might be some insulation here for consumers owing to lower energy prices. Now, we got some updates on the state of the housing market last week, and existing home sales were up and surprised analyst estimates. But new home sales dropped 14% last month, and house prices fell for a second consecutive month. Weakness in the new home market has funneled through to dour homebuilder sentiment. Now, the top clip of this chart shows that homebuilder sentiment is about as low as it's been in this cycle. Now, that's important because construction employment can be a solid leading indicator of the economy. For now, we're still seeing growth in construction payrolls, but it has slowed. If home builders ease their pace of development, then construction employment could stumble in the upcoming months, and that's something that we'll be paying attention to. Also, an economic headwind, the personal income and outlays report was weak for May. Both incomes and outlays contracted for the month. For the year, real personal income, shown here in orange, uh, was only up 1.7%, and that's a pretty weak reading. That should see consumption follow suit, which would be a notable economic headwind. Now, our base case right now is that economic growth is slowing to about a 1 to 2% growth level. But that doesn't mean recession is imminent. In fact, this recession probability model aggregates individual state level data and it shows very low probability of recession. So let's not confuse slow growth with outright contraction. From a technical perspective, we got a really strong bounce off the April 8th low. And in early May, several high conviction technical indicators gave bullish signals. This one compares stocks that have advanced over 10 days to stocks that have declined over that time period. It gave a bullish signal on May 5th. Of 56 prior signals, 55 saw the market higher 12 months later. The median gain has been about 17%. Now, of course, the market's already rallied almost 10% since May 5th, so upside may be limited to single digits from here. And in fact, we do expect stocks to gain no more than earnings over the next year. That's because valuations are stretched, as shown here in orange. There probably isn't much room for stocks to get even more expensive than they currently are, and that implies that gains can only go so far as earnings take us. Now, for now, analysts expect solid earnings growth in the next 4 quarters, but there are downside risks if the economy continues to slow or profit margins are pressured by tariffs. So, to wrap things up, previous geopolitical events have seen an initial downside reaction followed by a strong 1 year advance. US large cap stocks are back to their all time highs, and international stocks have continued their advance. There's likely some pipeline inflation pressures that have been building, but an offset could be lower oil prices. We're keeping an eye on home builders and construction employment, and that's okay for now, but a risk as the year progresses. Additionally, income and spending data was weak in May. Slowing incomes are likely to mean slower consumer spending, but we shouldn't confuse a slowing in activity with an outright recession. For now, it's a bull market environment with upside likely limited by the degree of earnings growth. That'll do it for this week. And as always, thanks for joining us and have a great week ahead.